Canadian mortgage rates are expected to stay much higher than expected, and it's not only because of the inflation. We also have to pay attention to the bond market. And when bond yields are dropping because people are pulling out or investing money into the bond market, it affects mortgage rates in the long term. Now, if we look at the Canadian bond market, a lot of people are pulling investment out of the bond market, and that's causing the Canadian banks, the Bank of Canada, to raise their rates to entice people to come back. Whenever bond market rates do go up, that does lead to long-term mortgage rates going up too. So we could see a rise in the 5-year mortgage rate. Right now, the major banks at a 5-year mortgage rate are offering 6.79, some of the major banks. And going into next year, 2024, there's about 20% of the mortgages are coming due. So 20% of the people that have mortgages in the last 3 to 5 years with much lower rates are going to have to renew into a much higher rate. And they're not really going to be able to negotiate their rates either, because if you go to a different bank, then you have to requalify again. And the stress test that's being applied will make it very difficult for you to qualify, so you're most likely going to have to stay with the same lender you're at. So that lender has an advantage not to give you a discounted rate, because in reality, no, you can't really go anywhere. And one of the other things concerning is in the U.S. market, China and Japan are pulling out of the market when it comes to the bonds. They have to deal with inflation in their own countries. What they're doing is selling U.S. treasuries and buying their own and taking their own currency off the market to help stabilize their own currencies. Again, when this happens in the U.S., this leads to higher yields being offered by the bonds because they want to entice other countries to come back, buy our debt, we'll pay you a higher rate. And when they pay that higher rate, it reflects in the long-term mortgage rates. So if we look around the bond market all over the world, we are seeing this trend. And also the Saudis have also pulled out of U.S. treasuries. And the reason we pay attention to the U.S. market so much is because when the rates go up in the U.S., Canada has to follow suit. They are our biggest trading partner. If they have higher rates than we do, that will lead to inflation in our country because our people will be forced to pay more for goods coming from the States, and that will reflect on prices in our stores. So it does look like the bond market is going to be offering higher yields to entice people to come back in their market, and when they do that, it's going to lead to higher mortgage rates for a longer term. Again, keep this in mind for yourself when you're coming to renew your mortgage or any of your investment properties. The only thing that could bring the bond market in the U.S. To offer lower yields, if we have some kind of black swan event in the world, some major bank fails, or there's some major crisis like 2008, a financial crisis, majority of the world will run back to U.S. debt because U.S. is the big boss. They pay their debts. They have the money to do it, and people feel more secure with them when they feel there's instability in the world. So for now, until there's something like that happens, which is not something we're looking forward to either, we don't want any black swan event to kind of cripple the international markets and cause chaos in the world. But if something like that does happen, people will run back to the U.S. That will cause them to purchase the bonds, and mortgage rates will be forced to come down, causing some relief in the U.S., and which will reflect directly into Canada. Again, it's Real Estate with Raza. Please like and subscribe. If you have any questions for your personal situation and how you can kind of navigate through this market, give me a call anytime, 416-995-7317. Until next time, take care. Bye-bye.